Okay, let's unpack this. We're diving deep into the infrastructure of, well, arguably the most successful investment empire ever built.
Yeah.
We often think of Warren Buffett as this, folksy sage just buying good companies and holding them forever. But that narrative, it really masks a truth that's far more compelling, much more complex.
Exactly. The mission of this deep dive is really to move past that comfortable image and focus on the brass tacks. We're talking about the actual financial mechanics, the engineering, the underlying corporate structures Buffett designed, not just to build, but critically to command his investment empire, especially in those years after the early partnerships. We're looking at the foundation that let him shift from being a really successful money manager to, well, an unparalleled financial architect.
And I think to truly appreciate that architecture, we had to start by just establishing the sheer scale of the wealth he eventually commanded. It's often hard to wrap your head around these numbers, right?
Right.
But our sources give us this data point from 2005 that, honestly, it brings the concentration of capital into sharp focus.
It's a necessary, almost alarming point of reference, really sets the stage. So in 2005, Buffett's personal fortune was sitting at about $44 billion. Now, if you combine that with Bill Gates' wealth at the time, which was around $46.5 billion, their joint fortune was just over $90 billion.
Okay, $90 billion. Huge number.
Huge. But here's the stunner. That $90 billion was barely less than the combined wealth of the bottom 40% of the entire U.S. population. Their total was around $95 billion.
Wow. Wait, say that again? The bottom 40%?
The bottom 40%, roughly 120 million people at the time.
So just think about that magnitude for a second. Two individuals controlling a financial force, almost equivalent to 120 million Americans combined. So the real question isn't just how he invested, is it? It's about the specific, maybe surprising corporate structures and strategic power plays that defined his path. How did they let him wield that staggering scale of capital, especially in that post-partnership era?
That's really the heart of our mission here. It's about revealing that systematic shift he made, moving from managing personal capital and partnership funds to leveraging the inherent sustained financial power of the corporate entities he controlled.
Right. So let's begin at a point that seems almost contradictory to this image of infinite wealth we have now, the strategic reset.
Yeah.
We need to unpack this critical moment when Buffett's personal financial reserves were actually, well, gone, exhausted, and that forced him to completely shift his approach.
Yeah, this is a crucial pivot point that often gets glossed over in the history books. After running his investment partnerships so successfully for years, Buffett hit this wall, a point of personal financial exhaustion. The sources are quite clear. They detail that he literally ran out of gas.
Ran out of gas. What does that mean in practical terms?
It means he had used every cent of the $16 million in liquid cash he'd secured from winding down that partnership phase. Now, $16 million then was a massive sum, obviously, and he poured all of it into buying controlling stakes, or at least major interests, in two main companies, Berkshire Hathaway and Blue Chip Stamps.
Okay, so he successfully converted his personal fortune, his liquidity, into corporate control.
Oh.
But the cost was his own personal cash flow as the liquidity was gone.
Precisely. And he described the consequence himself. He said, quote, he had to start his personal net worth over again from zero.
Zero, really?
Zero personal liquid net worth, yes. That's the great paradox, isn't it? Here he is, this emerging corporate power broker controlling substantial assets through these companies, yet personally, he was cash poor. So now let's contrast his personal income with the corporate resources he actually controlled. It's quite revealing.
Yeah, tell us about the salary. Sources mention a figure that seems, well, surprisingly modest.
Yeah, remarkably so. His stated annual salary from Berkshire Hathaway was just $50,000.
$50,000?
Yeah.
A year?
$50,000 a year. Now, he did receive some additional fees, like from managing FMC, which was likely Fidelity Mutual Casualty, or a similar insurance-linked entity he was involved with. These fees were a kind of structured compensation tied to the operations he oversaw, but honestly, they were minor compared to the cash flow moving through the companies themselves.
Okay, so on paper, he's making $50,000, which, I mean, it was comfortable back then, sure, but it's nowhere near the income you'd expect from the CEO running a multi-million-dollar holding company even then. What does this contrast really tell us about his strategy?
It tells us that the definition of wealth and power fundamentally shifted for him at that point. The true source of his power wasn't his modest salary or his personal capital gains or even any remaining liquid funds he might have scraped together. It became the vast, perpetual internal cash flow being generated and held by the companies he controlled, specifically Berkshire Hathaway and its subsidiaries. The strategic reset really defined the future empire. It was about moving away from relying on individual partnership capital and instead leveraging the corporate machinery itself for continuous, systematic capital generation.
That's the moment he truly became a financial architect, wasn't it?
Yeah.
Designing systems to generate capital, not just picking stocks to invest it in.
Exactly.
And the central pillar of that corporate architecture, the real engine of capital generation, is this concept of float, which sounds simple, but it's more than just a smart idea, isn't it? It's a disciplined, systematic strategy rooted in the insurance business. How did he actually engineer this corporate cash flow mechanism?
Well, the float engine is absolutely critical because it offers this almost magical financial advantage. Interest-free capital. It's quite something. Think about it. When you buy insurance, car, home, whatever, or even reinsurance, you pay the premium up front. Immediately, that cash is received by the insurance company ahead of time, sometimes years ahead of when they might actually have to pay out a claim, if they ever do. That big pool of prepaid money just sitting there, that is the float.
So the insurer is essentially getting a loan, like a perpetual interest-free loan from all its policyholders, and then they get to invest that money for their benefit until claims come due.
That's exactly it. And the genius of Buffett's engineering was creating a sort of self-sustaining structure to capture this cash stream and then funnel it where he wanted it. Our sources describe him setting up this pipeline structure. It was specifically designed to systematize the movement of cash between the entities he controlled.
Okay, detail that pipeline for us. Which companies were involved? How did the cash flow?
Right, so he needed a mechanism to inject this float directly into one of his key investment holding companies, which was called Diversified Retailing. To do this, he established a reinsurance company, called it the Reinsurance Corps of Nebraska, fittingly, and he strategically placed this new reinsurance company inside Diversified.
Okay, within Diversified, why reinsurance specifically?
Because reinsurance companies insure other insurance companies, it allows them to tap into these massive aggregated pools of risk and therefore capital. It scales things up. So Diversified now owned a company whose entire job was basically to insure other insurers.
Clever. So how did he connect this new reinsurance arm back to his main cash generators? Where did the actual float come from?
This is the key connection. The Reinsurance Corps of Nebraska agreed to take on part of the insurance business being written by one of his best-performing assets, National Indemnity. And this link was absolutely vital. National Indemnity was already known for being a highly profitable insurer, and crucially, it was known specifically for generating substantial, stable, and importantly, long-duration float, cash premiums that would likely sit there for years, even decades, before any potential claims might need to be paid out.
That is, wow, that's truly ingenious. He's taking a proven cash cow, National Indemnity, and using a subsidiary located in another one of his controlled holding companies, Diversified, to systematically siphon off those cash premiums, the float, purely for investment purposes within Diversified. But wait a minute, isn't that ethically questionable, or at least complicated? You're taking cash generated by one company, National Indemnity, and explicitly funneling it into a legally separate entity, Diversified, just for investment. How do you justify that movement of capital, especially to any shareholders of National Indemnity who weren't also owners of Diversified, assuming they weren't identical groups?
That's the essential structural nuance we really have to examine, and it's where the architecture gets intricate. The justification, legally and operationally, lies in framing it as a legitimate reinsurance transaction. Diversified's subsidiary, the Reinsurance Corps of Nebraska, was taking on a portion of National Indemnity's risk. And for taking on that risk, it received premiums, the float. It was structured as a standard business agreement between insurers. Now, the result, regardless of how you might view the ethics from different shareholder perspectives, was incredibly effective financially. As time went on, this pipeline systematically funneled millions upon millions more dollars of investable float directly into Diversified's coffers.
And that gave Diversified this enormous pool of liquidity that was essentially free money, wasn't it? Cost-free capital. It multiplied his capacity for investment massively without needing to raise external debt or issue more equity and dilute existing shareholders. It's this strategic leveraging of time and risk where the cash starts working for him immediately at zero cost.
Precisely, the power of float.
So this float engine naturally leads us to the next phase, which sounds even more intricate, this complex web of entities. We have Berkshire Hathaway, the flagship textile mill turned holding company. We have Blue Chip Stamps, the trading stamp company. And now we have this cash-rich investment vehicle, Diversified Retailing. The sources really highlight this intricate, sometimes overlapping, cross-cutting ownership structure between them.
Yeah, this layering of entities is a classic hallmark of financial titans aiming to maximize control, often with minimal personal capital outlay. You see echoes of it throughout financial history, like the voting trust J.P. Morgan used decades earlier. In Buffett's case, once that float pipeline started generating substantial, basically free cash flow for Diversified, the company immediately began putting it to work, buying stocks.
And what was its primary target? What was Diversified buying with all this float cash?
Principally, according to the sources, it bought stock in blue chip stamps, and most importantly, in Berkshire Hathaway itself. The sources note that Diversified soon owned a pretty significant stake in Berkshire, about 10%.
Okay, this is where the engineering gets really interesting, maybe a bit murky. If a company controlled mainly by Buffett and his close partners, Diversified, is buying stock in his flagship public company, Berkshire Hathaway, how is that functionally any different from Berkshire just buying back its own stock?
That distinction is absolutely the key to understanding the strategic advantage they were building. It seems similar, but legally and financially it was quite different. If Berkshire Hathaway itself bought back its own stock, the benefit, like the proportional increase in ownership value for remaining shareholders, would accrue pretty much equally to all existing Berkshire shareholders at the time.
Like everyone's slice of the pie gets bigger proportionally. But when Diversified bought Berkshire stock instead,
The benefit was concentrated significantly. The sources are clear. The owners of Diversified were not exactly the same group as the owners of Berkshire Hathaway. The core owners of Diversified were essentially Buffett, Charlie Munger, and Rick Gottsman, the tight inner circle. So by directing that float capital generated by National Indemnity through the reinsurance pipeline into Diversified, and then using Diversified to buy Berkshire shares, they were effectively using corporate resources generated ultimately by National Indemnity's policyholders to increase their own personal percentage control over Berkshire Hathaway.
without having to extend that same benefit or the cash used directly to the wider pool of public Berkshire shareholders.
Exactly. This move allowed them to amplify their power and control within Berkshire through the smaller, more tightly managed entity, Diversified. It was a structural multiplier effect for their influence.
That really is a masterclass in using corporate architecture to amplify control. But the common narrative often paints this picture of a completely unified front, Buffett, Munger, Gottsman, always in lockstep. That seems to crack a bit when we look closer at the internal partner dynamics described in the sources.
Oh, it absolutely does crack. And this provides a fascinating counterpoint to that monolithic image of the oracle and his unerring judgment. The internal power dynamics weren't always smooth sailing, not at all. Charlie Munger, for instance, apparently pushed back quite hard against being seen as just Buffett's echo or alter ego. When he was questioned under oath in some proceeding, Munger flatly denied being Buffett's alter ego. He acknowledged they had similar speech patterns, shared a core investment philosophy, sure, but Munger insisted, and I'm paraphrasing slightly, I have never chosen a role of being just a junior partner. I like the idea of having my own sphere of activity.
His own sphere of activity. That suggests Munger's investments and decisions through Blue Chip and Diversified weren't just him rubber-stamping Buffett's ideas. They were genuinely independent, at least to some extent.
Precisely. And we have this remarkable anecdote from the sources that demonstrates this friction very clearly. It's quite revealing. At one point, Munger and Gottsman apparently identified a specific attractive block of blue chip stock that was available. They wanted Diversified to snap it up immediately using some of that readily available float cash. Makes sense. However, Buffett apparently wanted that exact same block of blue chip stock for Berkshire Hathaway, the main public company.
A conflict. So you have the inner circle's vehicle, Diversified wanting the stock and Buffett wanting it for the flagship, Berkshire. This led to what the sources call a discussion. Yeah, I love that understatement. Given the personalities and the stakes, that must have been quite an intense discussion.
You have to imagine, right? 3 brilliant, strong-willed investors debating where a key asset should land within their own structure, and the outcome. According to the sources, the combined strength of Munger and Gottsman actually overpowered Buffett in that specific discussion.
Overpowered Buffett. Wow.
Yes. Diversified, the entity, controlled by the tight inner circle, got the stock, not the public flagship, Berkshire Hathaway. It's a fantastic illustration that even within this highly disciplined, engineered system, there were real checks, balances, and definitely some friction among the key decision makers. It really contradicts that public image of Buffett as this solitary, infallible figure making every single call a loan.
A crucial detail. And despite building this incredibly intricate web of interconnected companies, Buffett maintained strict control over who could even participate at the ground level, right? The sources note he actively forbade outside investors, even friends, from joining the fold at that time.
He did. It's another layer of control. Even as he was masterfully layering these entities and building up this internal capital engine, he still famously forbade his friends to buy Berkshire stock directly. The inner circle of control, the partnership essentially steering the float engine through Diversified, was intentionally kept very narrow, protected. It was focused on maximizing their unique structural advantage. The complexity and the direct benefits of that structure were reserved for the select few. Outsiders weren't invited into that specific mechanism.
Okay, so the system they engineered back in the 70s and maybe early 80s, this self-funding float engine, the tightly controlled web of entities, this created the immense, stable financial reserves that then allowed Buffett to act as this definitive financial titan on the global stage decades later. Let's jump forward now quite a bit to 2008. Let's see that power in action during the peak of the financial crisis.
Yes, the 2008 meltdown is really the perfect crucible to demonstrate the strategic power generated by those decades of disciplined float accumulation and structural engineering. When the entire global financial market was essentially paralyzed by fear and uncertainty, Buffett's capital, held within Berkshire, wasn't just stable, it was instantly deployable, massive amounts of it. And his actions, or even the potential for his action, served as the ultimate market test of confidence. We see this play out really clearly in two contrasting examples from that period, starting with the ill-fated Lehman Brothers.
Right. Lehman was absolutely desperate for a lifeline in those final days. CEO Dick Fuld famously went to Buffett, hat in hand, seeking a capital injection. Right. What was the nature of Buffett's offer? Was it generous?
Generous is probably not the right word. Buffett provided an offer, yes, but the sources state very clearly that Fuld considered the required terms preposterously expensive.
Preposterously expensive. So this wasn't charity.
Not even close. This was Buffett, acting from a position of immense strength in a crisis, demanding an incredibly high price for his commitment. He knew the value of his stability, of the Berkshire Hathaway name lending credibility. Fuld ultimately rejected it. He opted instead to try and raise about $4 billion in convertible preferred stock from Lehman's existing investors, a last-ditch effort.
And the implication of rejecting Buffett's expensive money in favor of trying to raise their own capital from existing, likely nervous investors.
The crucial implication, as the sources point out, was about confidence, or rather the lack thereof. The external investment Lehman managed to scrape together hardly came with the confidence and investment from him Buffett would have inspired. In that panic-stricken environment, the market wasn't just valuing capital, it was valuing certainty and the stamp of approval from someone utterly solid. When Buffett invests, especially in a crisis, he doesn't just bring cash. He brings the perceived stability, the fortress balance sheet of Berkshire Hathaway. Lehman's failure to secure that imprimatur, even at a high cost, was arguably devastating for market perception in those critical hours.
A huge what-if in financial history. And then we see the complete opposite effect play out just days later with Goldman Sachs. They were facing a similar existential panic. The market was seizing up, but they accepted Buffett's terms, didn't they?
Exactly, a stark contrast. On September 24th, 2008, right in the eye of the storm, Buffett made this decisive strategic move to stabilize Goldman Sachs, a pillar of Wall Street teetering. He committed to purchasing $5 billion in Goldman Sachs stock. And this transaction was apparently facilitated by a crucial, very quick phone call, no lengthy negotiations. And the terms of that deal reveal the true financial engineering and the leverage he had. Okay, let's get into the specifics. He wasn't just buying $5 billion of regular common stock on the open market, was he? What did Goldman actually give Berkshire for that $5 billion lifeline? No, this was a custom deal, highly favorable to Berkshire. He bought $5 billion worth of perpetual preferred stock. This wasn't common equity. It was a special class of stock that guaranteed Berkshire a hefty 10% annual dividend, paid first before common shareholders got anything.
10% annually.
Yeah.
Guaranteed.
10%. That's $500 million in guaranteed income flowing into Berkshire every single year, perpetually, regardless of market conditions or Goldman's profitability, as long as they could pay. And in addition, and this is crucial kicker, Berkshire also received warrants. These gave Buffett the right, but not the obligation, to buy another $5 billion worth of Goldman's common stock at a fixed, predetermined price, $115 per share, anytime over the next 5 years.
Wow. So let me get this straight. He essentially made an extremely safe, high-yield loan to Goldman at a guaranteed 10% interest rate via the preferred stock, while also getting a massive free call option. the warrants allowing him to profit enormously if Goldman recovered and its common stock price soared, which it eventually did.
You've got it exactly. It was an incredibly profitable, very low-risk transaction for Berkshire, essentially subsidized by the extreme fear gripping the market at that moment. He wasn't just stabilizing Goldman Sachs. He was executing a phenomenal capital deployment, putting that accumulated float to work at extraordinary terms, terms only available because of the crisis and his unique position. That single action demonstrated his unparalleled power to lend confidence, to basically signal to the market that a major institution was safe precisely when the market was completely paralyzed. And, the sources briefly mention his longstanding connections within the financial elite, going back decades to figures like Sidney Weinberg of Goldman Sachs. Those relationships likely ensured that when the crisis hit and he needed to act fast, his phone call could bypass all the usual layers of due diligence and bureaucracy. He could capitalize on that psychological moment of panic almost instantly.
Right. The corporate empire he built quietly over decades, powered by that float engine, allowed him to become the ultimate visible hand in the crisis, demanding and receiving extraordinary returns in exchange for providing that critical stability. It's quite a picture.
It really is. It connects the structural foundation directly to the crisis intervention power.
So this entire deep dive has really been about dissecting the strategic, almost mechanical decisions that underpin the Oracle's success story. I think the ultimate takeaway here is that Buffett's genius wasn't just in superior value identification, picking the right stocks, though obviously he was brilliant at that too. It was perhaps equally, or maybe even more so, in the ingenious creation of a corporate architecture, a system that perpetually generated and recycled investment capital in very low or zero cost.
Absolutely. I think that's the core insight. He experienced firsthand that personal pain of running out of cash early on. And that scarcity, that constraint, seems to have forced a kind of strategic mastery of financial engineering. He learned he couldn't rely on just his own funds, so he systematically structured these corporate entities, leveraging that non-traditional source of capital insurance float to ensure that his companies, not his personal savings account, became the endless engine for growth and investment capacity.
The structural advantage seems undeniable. He created a system where he didn't have to constantly rely on traditional bank debt or continuously issue new stock and dilute his existing shareholders. He could finance massive purchases using essentially zero-cost capital, the float, and then systematically reinvest the proceeds, the profits from those investments, at highly profitable rates over decades. A compounding machine built on free money.
Which brings us right back to that provocative thought we want to leave you, the listener, with. The success we've discussed today, the almost unimaginable wealth, the market-moving influence, was enabled by this structural advantage, wasn't it? Not just an intellectual one. So the question, perhaps, for the modern investor or anyone studying business is this. If arguably the greatest investor of our time achieved so much of his success, not merely through superior stock picking, but by designing and controlling a business structure that perpetually generated essentially zero-cost capital to fuel those investments, what does that imply about the true nature of modern financial success at the highest level?
Yeah, that's a powerful question. Is the ultimate edge found by spending all your time trying to identify a company trading at, say, 80 cents on the dollar? Or is it found by engineering the environment, the structure? The structure where you can comfortably buy $100 worth of assets at their fair price of $100, but you get to do it using money that effectively cost you nothing to obtain and hold. It really makes you think about the balance between capital structure and asset valuation, doesn't it?
A lot to mull over. The deep dive continues in your mind.
And that's all the time we have for this deep dive. Thanks so much for joining us and walking us through that.
Always a pleasure. Fascinating material.